Starting a business is thrilling, isn't it? You have this incredible idea, this fire in your belly, ready to change the world. But here's a hard truth. If you don't speak the language of business, even the most brilliant idea can fizzle out. It's like trying to navigate a new country without a map or knowing the local language. You'll get lost, fast. But don't worry, I've got your back. In this video, we're going to demystify the essential vocabulary you need to succeed. We'll break down the top 10 business terms every new entrepreneur should know. I'll explain them simply. With real-world examples you can start applying to your own venture today. By the end of this, you'll be speaking the language of success with confidence. Let's start with the big one. Term number 1. Revenue. You hear this word thrown around all the time. Revenue is the total amount of money your company brings in from its sales before any expenses are taken out. Think of it as the top line on your financial statement. It's the gross income. For example, when you hear that a massive company like Apple had revenue of over $380 billion in a year, that's the total value of all the iPhones, MacBooks, and services they sold. A high revenue figure is a great sign. It means people are buying what you're selling. But, and this is a huge but, high revenue does not automatically mean your business is profitable. It's just one piece of the puzzle. Which brings us directly to our second, and arguably more important term, profit, also known as net income. Profit is the money you actually get to keep. It's what's left after you've paid for everything. And I mean everything. Your rent, employee salaries, the cost of your materials, marketing expenses, taxes, all of it. So you take your total revenue and subtract all your total costs. If your coffee shop generates $100,000 in revenue. Now, let's talk about something that can make or break a company, even a profitable one. Term number 3. Cash flow. Cash flow is the lifeblood of your business. It's the constant movement of money in and out of your company's bank account. Here's a classic trap for new entrepreneurs. Your books say you're profitable, but you have no cash. How? Maybe you made a huge sale, but your client has 90 days to pay you. In the meantime, you still have to pay your rent, your suppliers, and your employees this month. If you don't have the cash on hand to cover those immediate bills, you're in what's called a cash flow crunch. A positive cash flow means you have enough money coming in to cover what's going out. Managing it well is what keeps the lights on day to day. Profit is theory. Cash is reality. Okay, so you're spending money to make money, but is it working? That's where our fourth term comes in, ROI, or return on investment. This is a simple but powerful calculation that measures the efficiency of an investment. It answers the question, for every dollar I put in, how many dollars did I get back? Let's say you spend $1,000 on a social media ad campaign. That campaign directly leads to $2,000 in new sales. Your profit from those sales is $1,000. So, your return on your $1,000 investment is $1,000, which is an ROI of 100%. Smart entrepreneurs are obsessed with ROI because it helps you identify what's working and what's just wasting your precious time and money. It guides you to double down on the strategies that deliver real results. Next up, term number 5, the break-even point. This is a critical milestone for any new business. It's the point at which your total revenue is exactly equal to your total costs. You're not making a profit, but you're not losing money either. You've broken even. Imagine you open a small bakery. Let's zoom out from your business to the bigger picture with term number 6. Market share. Market share represents your company's slice of the total sales within your industry. Think of the entire industry as a big pizza. Your market share is the size of your slice compared to your competitors. For instance, in the global electric vehicle market, Tesla has a significant slice, controlling around 20% of all sales. If your market share is growing, it's a fantastic indicator that you're not just growing with the market, but you're actively taking business away from your competitors. It shows you're becoming a stronger player and a leader in your field. Now for a term that gets investors really excited, scalability. This is term number 7. A business is scalable if it can handle significant growth in revenue without a proportional increase in its costs. In other words, you can serve more and more customers without your expenses blowing up. A classic example is a software company like Netflix. Once they've developed their platform and licensed the content, the cost of adding one more new subscriber is almost zero. But that new subscriber brings in full monthly revenue. Compare that to a handmade furniture business, where to double your sales, you likely have to double your materials, your workshop space, and your labor. Scalable businesses have the potential for explosive growth, which is why investors love them. Let's get a bit more advanced with our 8th term, NPV, or net present value. This sounds complicated, but the concept is simple and incredibly powerful. NPV helps you figure out if a long-term project or investment is truly worthwhile by telling you what its future earnings are worth in today's money. A dollar today is worth more than a dollar a year from now because of inflation and the potential to earn interest. Let's say a new project will cost you $10,000 today, but it's projected to bring in cash flows totaling $15,000 over the next 3 years. NPV discounts those future earnings back to their present value. If the NPV is positive, the project is expected to be profitable and add value to your company. It's a go. If it's negative, you should probably avoid it. It's one of the best tools for making smart, long-term financial decisions. Our ninth term affects every single business and consumer. The interest rate. An interest rate is simply the cost of borrowing money. When you take out a loan, the interest rate is the percentage you pay back on top of the principal amount. But it's also the reward for saving or investing money. When central banks raise interest rates, it becomes more expensive for businesses to borrow money for expansion and for consumers to get mortgages or car loans. This tends to slow down the economy. When rates are low, borrowing is cheap, which encourages spending and investment. Understanding the direction of interest rates helps you make strategic decisions about when to take on debt, when to invest, and how to price your products. Finally, we arrive at our 10th and perhaps most personal term, equity. Equity is your ownership stake in the business. It's the true value of what you own. To calculate it, you take the total value of your company's assets, everything it owns, and subtract its total liabilities, which is everything it owes. If your business is valued at $100,000 and has $40,000 in outstanding loans, your equity is $60,000. For an entrepreneur, equity is your skin in the game. It's the reward you get for taking all the risks. As your business grows and becomes more profitable, your equity value increases. This is how entrepreneurs build real, long-term wealth. So there you have it. Revenue, profit, cash flow, ROI, break-even, point, market share, scalability, NPV, interest rate, and equity. Mastering these 10 terms gives you the foundational knowledge you need to build a solid strategy. Speak confidently with investors and make smarter decisions every single day. Because in the world of business, knowledge isn't just power, it's profit. You're no longer just an enthusiast with a great idea. You're an entrepreneur who speaks the language of success. Thank you so much for watching. If you found this breakdown helpful, please hit that like button and consider subscribing for more videos designed to help you build and grow your business. Let me know in the comments which term was the most eye-opening for you. I'll see you in the next video.
BizBriefed, your daily business brief.